Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Awesome. Okay, well, we've got some super current relevant topics we want to cover today. And a lot of the stuff I think often gets misunderstood because it's discussed so broadly in the media and by political talking heads that I don't know that we always pick up on what it means and how it applies to us. This rang true for me specifically. I'll tell an anecdotal story about that experience that I had. In 1995, I was sitting in AP European history class in high school, and Kevin Rigby was our AP European history teacher. He'd been teaching this subject now for several decades and talked to us about the Rock of Gibraltar and talked to us about how Spain and Morocco would always battle over the Rock of Gibraltar and how there was wars that were being held over who possessed the Rock of Gibraltar. In my mind, this was some kind of jewel-encrusted football that they would then go and fight over as to who would possess this thing. I finally raised my hand and I said, Mr. Rigby, I'm just confused. What was so special about the Rock of Gibraltar that these two nations would war over this thing? Did they believe it possessed some kind of magical power? Did they, was it of great worth because it was some kind of, there was jewels, or what was it about this thing that was, causing these nations to war over it? And he began to laugh out loud, kind of buried his head laughing out loud. And he realized the room was silent. And he sat up and looked around and realized that every student in that classroom had the same inquisitive look on their face that I had had. And as he looked around the room, he said, now hold on a minute. How many of you are actually thinking the same thing that Paul just said? And everybody's hand went up. And he said, oh my goodness. It occurs to me right now that I've been teaching this lesson for 20 years, and I have sent thousands of students off into the world believing that the Rock of Gibraltar was a jewel-encrusted football. He says, you guys, it's a giant landmass critical to the strategy of the navies.
They weren't playing capture the flag?
No capture the flag.
Okay.
They were fighting over a landmass that was critical to the strategy and war of these two nations to control this landmass. So the point of my story is simply this. Sometimes I think that we talk about these things without other people always understanding what we mean by them. And that can lend itself to really a lack of our, comprehension of the application of that thing. Mm-hmm. So the relevant, most current stuff we can possibly be talking about today are things like the national debt, the debt ceiling, the pending debt crisis, and these big legislative issues that are surrounding those points. So let's start out with the $29 trillion question. Okay. What is the national debt?
So the national debt is all of the debt issued by the United States government that has funded liabilities over time that hasn't been retired yet.
Okay, perfect. So the Congress will approve a budget, right, for spending purposes, and they'll say, we know tax revenue will support most of this budget, but there will be some wish list items that we want to spend money on that are not going to be supported by tax revenues. The difference, we are going to need the Secretary, the Treasury, to issue debt so that we can finance the difference. Okay, now historically, they've had to go to the Treasury and get the Congress to get approval every time they've wanted to spend money that was beyond what the tax revenue would support. And in 1917, just during World War I, they decided this is too burdensome. So Congress approved legislation that said we'll establish a fixed amount of money, a ceiling of debt that we will allow the Treasury to issue. And so long as we stay within that ceiling, we don't need to get approval. We can just consistently spend money, write IOUs, and we will never need to worry about getting additional approval up until the time when we approach that threshold. And that's been the case since 1917. And so what we've had since then over the last 100 years is as we get to this quote unquote debt ceiling, Congress will sit down and say we have to raise the ceiling so we can issue more debt. And just to make sure everybody's really following us, what kind of debt does the Treasury issue? What does that mean to issue debt?
Yeah, they're issuing bonds. The US government is issuing bonds that individual investors, institutions, countries, whoever can buy.
Okay.
So it's just, yeah, like you said, it's an IOU that will be paid back later. And so as an investor, whatever kind of investor you are, you can buy that, get paid some sort of interest on it.
Yep.
And then get the IOU a few years down the road.
Perfect. And then they pay it back with a little extra.
Yeah.
Okay. And you said even countries can buy this stuff?
Yeah. A fair amount of our debt is owned overseas.
Yeah.
So owned around the world, even the Federal Reserve. We were talking about this earlier, and Scott mentioned, even institutions within the United States can buy it.
Yeah.
So
yeah.
Federal Reserve owns
Corporations,
some of our
institutions, Federal Reserve, private bank, they are even buying the debt that's issued by the Treasury. Okay. So the problem now is that we have this limit of debt that we're allowed to have that the Treasury can issue, and we've bumped up against that limit once again. And Congress has not changed the legislation on this since 1917. And in large part, this used to be an issue where when we would approach the debt ceiling, it was kind of a bipartisan, everybody get together and go, yeah, duh. The smartest thing to do is just to raise that limit so that we can spend more money. But as of the last, more recent years, this has turned into kind of a weaponized political football. Okay, how have we seen that happen? What's going on now?
Yeah, well, in 2013, when they were doing Obamacare, they were using that as a weapon, basically saying, hey, we're not going to have a bipartisan agreement on this. We don't want, and our condition is we don't want to fund Obamacare. So they essentially just use it as a condition to just sit on it.
Right. Yeah. So there's a lot of politicking that's happening now with this debt ceiling. And so the most recent time we saw this crisis hit was back in 2019. And in 2019, when we pushed up against the debt ceiling, they did something unique when they said, we'll suspend the debt limit until 2021. August of 2021, we'll suspend the debt limit up until that point in time. We'll revisit this conversation then. Well, the debt ceiling was set at $22 trillion, and they suspended the debt limit. Andrew, do you want to share the screen of what the current national debt is today? This is a little fun website. If you really want to get some anxiety, you can stare at this for a couple minutes.
Don't stare too long.
Yeah. And you can see up in the top left-hand corner, the current U.S. national debt is approaching $29 trillion. So that's not even the same zip code as our debt ceiling that was established 2 years ago at $22 trillion. And it wasn't established 2 years ago, but that was the one that we blew past. Okay. And so basically, August of this year, they said we need to, revisit the debt ceiling conversation. We're nowhere near the $22 trillion. So we knew we needed to increase that number. And the Treasury said, well, we've got enough money kind of lying around that we can finance the government through Q4 of this year, right? We don't need to issue more debt. We can finance the government. And keep in mind, this isn't like, we want to spend more money. This is like we need to pay back our credit card.
Yeah.
On stuff we already bought, right?
Yeah.
Stuff we already bought and paid for. We need to pay off our credit card on this stuff. And so the Fed or the Treasury said we've got money to pay for this. And then Janet Yellen came out a couple days back and said, hey, it's actually not through Q4. We've kind of run our forecast of what cash and reserves we've got available. It's October 18, right?
Less than 3 weeks.
Yeah. So a lot of people talk about like, the average American is, 6 weeks away from bankruptcy. Well, the America is 3 weeks, right? So no, and October 18th is going to be a rough day for me. I bought a Jimmy John's sandwich today on my app, and I'd earned a reward, like a little bonus coupon reward, and it was for a free pickle. And the expiration on it was October 18th. So I have to go back to Jimmy John's before October 18th to redeem my free pickle. And if I don't, then I lose my free pickle on October 18th, and the United States shuts down. So that's going to be a bad day for me.
Bad day.
Right? All right. So all joking aside, as of today, we've kind of circumvented this crisis right now. What happened today?
Yeah, so today there was a bipartisan agreement to further kick the can down the road. So they approved funding through December 3rd. So they didn't increase the debt limit, so it remains as is, but they did the same exercise that was previously done where they kicked that can down the road. So the immediate crisis has been averted, but kind of the long-term discussions around the proper levels of debt and spending and everything else very much remain outstanding.
So they suspended the debt limit. They
Yeah.
can continue to issue more debt without any congressional approval at all,
Correct.
right? Which is, super interesting to me that we can do that. So they've suspended the debt limit through December 3rd. At some point, we will have to obviously decide whether or not this exercise is futile and they just get rid of it altogether, or they actually increase the debt ceiling to a place where we can actually grow into. So there are three major bills that are taking place in legislation that are being discussed in legislation today. Let's hit those pretty quickly. The first is $1 trillion infrastructure package. What is that, and how does that impact our clients?
So the $1 trillion infrastructure package, this too has bipartisan support. And this is what one really, thinks of usually as infrastructure, bridges, roads, railways, et cetera. This is stuff to improve our kind of creaky and aging infrastructure. As I mentioned, broad bipartisan support. And we view this something as a tailwind for the economy. This is going to be stimulative in nature. The price tag of it probably doesn't lead to inflationary pressures. So from our perspective, this is probably a bill that's going to be beneficial from a economy's perspective and from a market perspective.
Yeah, stimulates more expansion in the economy, more expansion in commerce, and that all translates into market improvements for our clients' investments. Then it's kind of being linked to a second bill. They were initially they were supposed to be separate bills, but now they're being kind of lumped together. A second bill, which is a $3.5 trillion bill, which may be an understatement even in the price tag of that. What is that second $3.5 trillion bill?
Yeah, that's being referred to as human infrastructure. It's kind of a social safety net as far as how it's being viewed. So it's focusing a lot more on expanding Medicare coverage, reducing Medicare drug prices, making community college free for everyone, things of that nature. So healthcare reform, education reform, adding energy reform.
Right, there's climate
So,
change language in there to try to talk about the crisis of climate change and mitigating some of that.
right, different tax credits, expanding the child tax care or the child tax credit right now, earned income tax credit, expanding those things. So those are permanent in nature, whereas right now they're set to expire.
Right. And that one has on there. And this is a very apolitical conversation. We're not taking sides. We're just kind of relaying the news, so to speak. There's another piece of legislation that's going around called the Secure Act, kind of 2.0. We saw the original Secure Act come out in December of 2019. Some of the high level things, the Ways and Means Committee met September 13th to talk about some of these things. And it still doesn't have congressional approval, and it still hasn't gone on the president's desk for signing. But there are some high level things that we probably want to mention to you that may end up coming down the pike. And if they do, they will have some kind of impact. RMD ages would go to what? 75. They've talked about reducing the RMD or eliminating the RMD on any IRA balance below $100,000, and then additional tax credits.
Yeah, a lot of the Secure Act is revolving around employers getting tax credits. Is a lot of it.
Right. So a couple of quick items where they're talking about finding ways to pay for all this stuff. Right. This is where things get unfortunately scary. Right, because they got to pay for all this stuff. They got to issue more debt, and they got to come up with tax dollars to finance these wish list items. So we're seeing conversations going on around increasing capital gains taxes. One of the current discussions is on anybody who makes more than $1 million, raising the capital gains rate to all the way up to the highest marginal rate, which is 39.6% plus.
Which would be an increase because right now the highest marginal rate is 37.
Yeah.
So it'd be an increase up to 39.6.
And the highest capital gains rate today is 20%.
Yeah.
So, I mean, it would effectively double that capital gains rate on any $1 million income earner, plus add a 3.8% surcharge for that ACA surcharge. So that's a significant change. Now, again, I want to caveat all this conversation with these are things that are being discussed. It's all to be determined, right? We don't have any firm legislation on these issues yet, but these are things that are gaining a lot of traction that we do need to watch closely, and we'll keep our clients apprised as they come down the pike.
Paul, real quick, a couple other things: raise corporate tax rates to 28%, no stepped up basis at death, so you get a step up when you own any real estate stocks, the inheritors of those assets get a step up in basis, so they don't have a tax liability. You already talked about the capital gains eliminating or limiting like-kind exchanges. So right now we can do a 1031 exchange with property. Yeah, eventually down the road, closing backdoor Roth, things of that nature.
Yeah, and these are all things that kind of cause us some consternation with how the market would react to this kind of pressure, right? How the economy would react to this kind of pressure. And so we talk about these potential headwinds, and again, we want to be real cautious about how we present this, because we don't want everyone who's listening to this today to turn around and say, "Oh my goodness, they're telling us that the market is going to, immediately fall apart." We don't have that kind of feeling or sentiment in our office. We're not trying to portray that thesis to you. We just want you to be informed as to what's happening out there, as we are constantly watching these events take place. We want to try to digest them and make sure that you guys can understand them and how they impact you. So we do watch how it could impact the markets. And in any given year, the average intra-year market drop is what, Scott?
North of 10%.
Right. Yeah. As much as 14%. And so we plan on these kind of market conditions, impacting your investment accounts from time to time. And so that's why we talk regularly about smart retirement, right? The strategy of trying to put our investments into different buckets that allows for us to manage cash flow needs in retirement: our saved bucket, our protected bucket, our defensive bucket, and our growth bucket. By structuring our investments using smart retirement principles, we can manage cash flow during retirement so that we never have to sell shares of Microsoft at a 30% loss because of the geopolitical events or tax events that are causing kind of pressure on the market. And Microsoft is then selling at deep losses or deep discounts, and you're having to finance a vacation to Hawaii at a big expense to you because your investments are losing. So we break things into buckets, and one of these buckets is a defensive strategy, right? And those are our yellow buckets that we refer to with all of our clients. And one of our very favorite investment selection committees in this defensive strategy that we regularly put our clients into is called 3Edge. And we actually have the privilege of having them with us today. And Jonathan, Fritz, if you want to jump on. Scott, why don't you introduce our guests?
Yeah, thanks, Paul. So it is our privilege to have a 3Edge. We met both Jonathan and Fritz a couple years back, and just to give you guys some perspective, our clients, as far as how long we sometimes do due diligence, we kick the tires with 3Edge for about 2 years to really get familiar with their strategy and understand what they're about, and have had the pleasure of getting to know Fritz and Jonathan very well. And these are top-notch people and top-notch investment managers, just incredible market acumen. We pull data from a variety of sources to kind of form our market theses, and these guys are right near the top of the list. They have some great insights to the market, and we're fortunate to have them today. So Fritz Foltz will be joining us. Fritz is the managing partner and chief investment strategist at 3Edge, and then Jonathan Cressy is also on, and he's a managing director at 3Edge. So great to have you both with us. Thanks for
joining us, guys.
Thank you. Thank you very much.
Yeah, so let's begin, and Fritz, maybe you can take a stab at this, but just maybe give us a quick introduction to 3Edge and the methodology for the total return strategy specifically.
Sure, of course. Thank you, and thanks for having us. So, 3Edge Asset Management, we manage approximately $1.4 billion in assets, and our approach we describe as being a tactical multi-asset money management approach. And what we do is we construct portfolios of index ETFs. So we don't buy individual stocks, we don't buy individual bonds, but rather we access exchange traded funds, or index ETFs, if you will, to make our investments and to create our portfolios. And our portfolios are always globally diversified. They're diversified across asset classes, right? So that means that they're going to own stocks and bonds and real assets, which could include commodities and gold, as well as cash and currencies. So always broadly diversified portfolios across asset classes And we also invest globally. So we invest across geographies, US, Europe, Asia, Far East, and emerging markets. And as you had mentioned, our approach is very focused on risk management. And where we really want to shine is during those periods in particular where markets may suffer a rather material decline. Well, we want to, through our broad global diversification, owning many different asset classes that could be zigging when other things are zagging, and through our tactical approach. The tactical means that we make changes to the portfolio when our investment outlook changes. So if we feel that we're during a period of time when it's best to be somewhat underweight equities and be more defensive, we'll dial back our equity exposure. And then when we feel it's a time when it could be more attractive to be more fully invested in equities, we will increase our allocation. So we have very wide ranges for the asset classes in the portfolio, but the portfolios are always globally diversified, and we really focus on risk management. And so what we say is we're seeking to earn attractive risk-adjusted rates of return. We want to earn an attractive return, but we want to do so by taking as little risk as possible.
That's awesome. It's kind of a win by not losing approach, so to speak, right?
Absolutely. I wrote a paper. I'd be glad to share you. I call in investing, just like in football, defense wins championships. And if you can stay out of the way of those downturns and not have to dig yourself out of a very deep hole, well, then when the market turns back, you can just go on your merry way. And that's a very good way to achieve long-term investment success.
Yeah. So notwithstanding this recent pullback we've been experiencing over the last few weeks, the markets have seen a great run, right? We've seen some fantastic performance. Do you have any concerns about valuations or the overall state of the economy right now?
Yeah, so I remember we had lunch at the conference last week, and I think Scott asked me, well, how do you feel about U.S. equities? I think I said something like, oh, girl, I don't know, but yeah, I mean,
I think the word Fritz was terrible.
I think he looked at us and said, I feel terrible.
Yeah, and that pretty much sums it up. I mean, particularly in 2021. I mean, obviously the U.S. equity markets have done very, very well, all the way back to coming out of the financial crisis in 2009 and with the massive stimulus from the central banks, et cetera. We know that the markets have done well. But in 2021 in particular, when you look at the valuation of the U.S. equity markets, they've just gone beyond extreme. And we just feel that people are so speculatively positioned right now. We have excessive margin debt. It's climbed to levels higher than the late 1990s before the tech stock bubble burst. It's higher than in 2007, leading up to the subprime mortgage crisis. And so U.S. equities are as overvalued now really as they've ever been. And that doesn't mean that they can't keep going up. And that's what we've seen in 2021 so far. But what that means for us, and I actually have one other interesting tidbit for you, and that is that someone showed me that only 4 stocks, Microsoft, Apple, Google, and Tesla, account for approximately 50% of the investment performance of the S&P over the last 3 months. And, and when you just hear things like that, you know that, okay, now is not the time to be taking an enormous amount of risk. Now is not the time to be piling in to the U.S. equity markets. And so we've been closer to our minimums in U.S. equities, and we've been allocated, and I can go into that further, more in ex-U.S. equities, which have more attractive valuations.
And probably worth noting, I'm sorry, Mason, I'll let you, but probably worth noting, kind of for our clients, because when we diversify out a portfolio, right, the red buckets are exposed here, yellow buckets where you guys are doing, that's not. And where we are seeing, kind of earnings increase, you look at some of these valuations and you go, okay, we're trading at higher multiples, but we are seeing earnings. In some cases, you can almost argue the market is still affordable with earnings increases, right? So
Right. And some of that gets to how people do valuations. And so we look at price to sales. We think that's the most accurate way to do it. And you can make the argument that with interest rates so very, very low, if you discount future earnings, at those very low rates of interest, then you could say maybe the markets aren't quite so overvalued. However, in order to do that, you have to believe that interest rates are going to stay at these levels for the foreseeable future. And we may be starting to see that come undone a little bit.
Well, Fritz, we saw that on Monday a little bit, right? We saw some of those trades unwind a little bit where we saw the big bump in the treasury rate. And as a result, that discounting mechanism for growth stocks really becomes problematic. And we saw a big sell off on the growth side.
Yeah.
Fritz, you mentioned just a little bit ago about the allocation that you guys currently have. Can you hear me okay?
Yeah, I can hear you.
Okay. But the allocation that you currently have, I know that you're pretty diverse as far as international equities right now, and then you also have some bonds and even gold. I believe you got real assets in there too. Can
Yes,
you just
correct.
speak to the allocation today and how you guys come to that allocation?
Sure. So we don't use any Wall Street research. All of our research is model driven. So over the course of the last 40 years, in fact, Steve Cucchiaro, our president, chief investment officer, has been working, and as well as our folks at our firm have been working on developing a model that we use to do our research on the global capital markets. That model looks at valuations, which are longer term. It looks at economic and market fundamentals, which are more medium term. And it looks at investor behavior, because that can be important in terms of decision making. So right now, our model isn't signaling that we should be dramatically over or underweight equity. So we're sort of in the middle. But the valuation portion of our model is making other markets look more attractive in terms of equities, as I said. So we like Japanese equities. They are, from a valuation standpoint, they're much more attractive. And so we like Japan. We like India. Now, India is a market that, if you look at it a certain way, it always looks somewhat overvalued. But India is doing quite well, and they have elections coming up. So it's the Reserve Bank of India is probably going to remain stimulative for the foreseeable future, which is going to help them. We like European equities. They really struggled, as we know, with COVID. They're starting to get that under control a bit. But we're not jumping up and down in any of those asset classes, if you know what I mean. Like, we're not completely excited, but we're trying to cobble together an equity allocation where the valuations are more attractive, where we think we can carve out some return. Because one of the issues that you have here is, if you say, okay, the US market's overvalued, well, then it's a challenge to cobble together a portfolio that can earn you a decent rate of return, but yet not be taking too much risk to do that. I'll keep going on how we're allocated. We're closer to our minimum in treasuries, just because the risk return trade-off there is just not compelling. You know, the entire treasury yield curve yields less than expected rate of inflation. And so that's not, so we stay at our minimum. So remember, we always have a minimum and a maximum. So if I said that our model research absolutely hates the equity markets, we would still own some equities in each of our portfolios in the total return strategy, because, well, we could be wrong, right? And so you have to protect yourself from yourself a little bit. We'll always hold a minimum in equities. We don't like corporate credit, because as people have just been grasping for yield, they have forced credit spreads in the corporate markets to historically narrow, basically saying they're willing to take a lot of risk, and you're not even getting a great deal of interest more than you would in a treasury. But people are so desperate to get some more, because it's so hard to find yield, that the corporate credit market to us is risky. Gold for us, if you want to spend maybe just one additional minute on gold. So we always hold some gold in our portfolio. And there are two reasons for that. One, it's a very good shock absorber. Well, gold actually, by the way, today is up about 1.75%. It's a very good shock absorber in your portfolio. If things go wrong, if there's a geopolitical event, oftentimes investors will do what you would call a flight to safety, a safe haven asset. And gold can serve that role for you in your portfolio. It's a good shock absorber. We also look at gold as a form of money, right? And so sometimes I describe it like this. If you take your bar of gold and you buy it and you put it on the shelf, it doesn't do anything. It doesn't pay you interest, doesn't pay you a dividend. It doesn't tarnish. It sits there the way it has for thousands and thousands of years. But what changes is how much paper money it takes to buy that ounce of gold. And so when you're in a situation that we have been in since these central banks started to be so stimulative, where they're basically printing money, printing more and more money, what's happening is it's taking more and more of that paper money to buy your ounce of gold. If you look at that the other way around, the value of your gold is going up. So we look at it as a shock absorber and as a form of currency. We've done very well in gold. It's struggled somewhat recently, but we're still in a negative interest rate environment, where negative real yields, where nominal yields less than inflation, and that is usually a period where gold can do well. Commodities have had a very strong year. They're up 38% year to date. We were overweight commodities. We've backed off of that position now. We still own some commodities, but at a smaller level. And the reason that we backed off is there are concerns, particularly in China. China is just a massive consumer of commodities. So if you're worried about a slowdown in China, and there's just a lot of uncertainty in China with all the political decisions that have been made, and could be that their economy is slowing, that could affect the commodities market. So we've backed that off. But we had a very good run. They set up 38% year to date. So again, that's a broad overview. It's very diversified. And I think what I would leave you with is, when you think about our portfolios, and if you look at what is in the portfolio, the beauty of our model is not necessarily that it spits out a list of all the best things that you should buy, but the beauty of the model is its capacity to put together a combination of asset classes and geographies to try to earn as much return as you can with taking the least amount of risk. And that's really the strength of our model. And I'm sorry, I went on way too long to describe all those.
No, that was great. Thank you.
That's great. We do have a question that one of our clients has asked, and I think we'll save that question until after we finish the interview. With
yeah, and if it's a hard question, you should direct it to John Cressy.
We might just have time for maybe even just one more question with you guys, though.
Yeah, and I had a question for you, Fritz. So just as an example for your allocation recently, during the height of COVID-19, when the market saw a 33% downturn, with 3Edge, it went down about 8%. Can you talk to the point of how you navigated that entry point and what you did for the allocations within the portfolio?
Right. Sorry. Guilty of not turning off my phone. My apologies. I think your question is, you're referring to 2020 and how the market had that very steep decline from the third week of February through the third week in March. And yes, they're absolutely right. We declined much less. And the reason for that was that going into 2020, our model research was indicating that we should be more defensive in terms of our allocation to the equity markets. And the reason that was so was that what the model was seeing was the economy and the global economy was actually starting to slow. And so the economic and the market fundamental drivers were not supporting the equity markets as being attractive, and they were falling away. At the same time, the valuations were getting stretched, and the model was telling us that really the only thing holding up the markets was a positive investor psychology, positive investor behavior. So we became more defensive. Our model had no idea that we would have a global pandemic, obviously. We didn't know that. But what the model does know is that if there is an event, if something does happen, if there's a catalyst, well, then that market could really take a hit. So the onset of the pandemic occurred. We were defensive. The S&P declined dramatically, and we declined much less. But the good thing about the strategy in 2020, which really is a good test for any strategy because you had almost a full market cycle in a year, was that not only were we out of the way in a hit, But we started to get back, the model started to get us back into the market beginning in April and May, because the model was picking up this massive central bank stimulus. And very importantly, it was picking up the Fed expanding its balance sheet. And the Fed was willing to drive interest rates down to 0 to 25.25, right? Very, very low. But they were unwilling, the way Europe and others have, to go negative. But if your rates are basically zero, and then you start to expand your balance sheet the way the Fed did, that is the equivalent of going negative on your interest rates. So our model picked that up and said, yes, the news about the pandemic is horrible, but there is so much liquidity being created right now, and that liquidity is going to go somewhere, and it's going to find its way into asset prices. So that got us back into the market. And I think total return was up maybe 17%, something like that last year. So it was a very good test of the strategy, and we came through, and it worked out quite well. And I think, that's the benefit of having a disciplined approach. You're not going to be able to necessarily sit around a conference room and figure that one out. It's just, it's not possible. So we feel that we've taken our best thinking about what drives the markets, and we've put that into our model, and then we look to the model to help to guide our investment committee in making decisions.
And that's probably a perfect not only ending point, but how to answer this question. So the question, I'll just ask the question out loud, and then I'll just answer. The question was, how does what Fritz is describing rather, translate into my investments with Alliance Wealth Advisors? And so, again, we use smart retirement models. So not everything that we do with your money is being managed the way Fritz is describing how 3Edge manages their portfolio. That is a small component of a much larger financial plan. So within your yellow or defensive bucket, we have managers like Fritz, like Jonathan, who are selecting investments very, strategically and defensively and tactically with a ton of discipline in their model, right? To protect us from those downside volatility movements. And the way this played out for you, the person who asked the question, was in April and rather actually March of 2020, when we saw the market sell off about 33% in 22 trading days.
Yeah.
This particular strategy was down about 8% over that same period of time. And in spite of that, still had the close of the year out with roughly 17%. So our money in our quote unquote red buckets did not experience the downside protection of that volatility buffer. They didn't get that downside protection. They went down with the market, right? But the money in our yellow buckets tried to protect the downside. So how does that translate into a benefit for our clients? It's all about managing cash flows during retirement. We do not want to be in a position where we have to liquidate assets to finance your vacation to Hawaii at deep discounts when there are major periods of economic uncertainty. So that's why we have smart retirement models. And what Fritz and Jonathan and the team at 3Edge does is they play a critical role in your smart retirement management in those yellow bucket models. So with that, we want to thank you guys both for joining our call today with our clients. Super invaluable that we get this kind of access to talk to the very investment selection committees that are actually pulling the strings on our clients' investments. And I hope that everyone on the call can appreciate, what kind of accessibility they get to you guys there. We want to thank all of our clients who joined the call with us today, and those who will be watching this call later. With any questions you've got, feel free to reach out to us, and we'll walk you through, again, how this applies specifically to you. With that caveat, I also want to place out there, this information is all intended to be educational in nature and for a broad audience. We hope that everyone understands you do need to come and talk to us specifically for one-on-one consultative advice, whether it's legal, tax, or investment, before you act on anything we discussed today. It's intended for a broad audience and education and entertainment only. So you guys are wonderful. We appreciate the opportunity to be with all you today. And until we see you again next month, take care.